Hello and welcome to today's episode of Nucleus Investment Insights. Today we're looking for survivors in amongst the Quant Rubble. What does that mean, you may ask? Well, we're going to do a deep dive into the market sell-off, examining the quant factors that have changed during this period and what the implications may be for future moves. On the agenda, we'll do a quant recap, explaining exactly what that is for those listeners that are not familiar. Then we'll have an in-depth look at the different categories. So we'll examine low volatility stocks, momentum stocks, growth stocks, and then quality and value stocks. And of course, at the end, we'll give you the investment implications and a market outlook. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. And today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Thanks for putting on this much-loved podcast.
Thanks, Sam.
Great. So it's just the two of us today. So this is one of your areas of expertise. So we'll see where the show takes us. And just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show's available on all the majors. And just FYI for our listeners, if you'd like to look at the slides in more detail, we'll post these in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, we'll get started. So Damien, over to you.
Thanks, Sam. So I'm going to start with the quant side. So some of you might have heard of people talking about whether growth stocks are performing well, or value stocks, or quality stocks. And so I thought I'm going to give a bit of a recap about what they are, and then we'll sort of dig into what's been happening in terms of markets and which of the factors are being performing well, and obviously as well the key thing, where do you want to be positioned going forward in terms of these. So I guess to start with, what these are is they're mathematical models that are there to help try and generate performance. They don't always work, but they usually do, and a lot of it's a question about sizing and how much exposure you have, and whether the exposure is at the right time or the wrong time. Within most model, there's this implicit assumption about non-reversion. So basically, you're onto something that's going to keep going. And so I'll dig a little bit more deeply into that in a minute about what I mean. I guess it's the things to keep in mind is some of these processes might work 55-60% of the time. And so if you're using a sample size of one or two stocks, you could very easily be disappointed. Like most of the time, quant funds will run quite large models. We sort of run within ours. If you add the Aussie and the international together, we're close to about 100 stocks. But having said that, we would be on the smaller side of most quant funds. Many quant funds will run numbers into the hundreds of stocks to make sure they're getting enough exposure into the areas that they want to get exposure to. The number one question you've always got to ask with a quant process, however you've derived this, that you've decided this is the factors that you're going to use to face your to make your investments, is whether you're selling insurance to the rest of the market. And what I mean by that is selling insurance it feels really good because you make lots of money, you make consistent money. So the example is if I've got a method which is effectively the same as selling, say, home insurance to all my all the people who sit in the office with me, is that every month it feels really good. I'm winning. Like I'm charging $100 each, and there's 10 people there, and so I'm getting $1,000 every month. It's like, look at this money. Made $1,000 first month, $1,000 second month, bang, bam, 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 bam. I might go on there for 2 or 3 years, just like collecting this money and feeling how good is this, and then all of a sudden somebody's house burns down, and I've got to turn around and go, oh, just a minute. I've been collecting $1,000 a month, across for 4 years. That's, I've made myself $48,000, and all of a sudden I've got to shell out $500,000 to rebuild somebody's house. That's what I'm talking about, insurance. And there are quant methods out there where effectively what you're doing is providing liquidity to everyone else. And there's all these people who want that liquidity, or they don't want to have that exposure because they know every now and again. The person who's taking that $1,000 every month, all of a sudden gets a $500,000 bill, and so that's the that's the thing with every single quant process is looking over longer periods of time, trying to work out why is this generating a return for me. And so the traditional factors that that people sort of want to buy, there's reasons for them generating that return, and you can see why those returns will on average come out. But yeah, just picking a quant factor for whatever reason because it happens to backtest well, that's the most dangerous thing. Is you're buying a sort of an insurance type product, or a reverse insurance type product is probably the better way to put it. So I'm going to pick on sort of 5 sort of key categories that most the most common ones that people will look about and talk about in terms of stocks. And what they're, and I'll dig a little bit deeper into these, but so there's and of the 4 out of the 5 have this assumption of no mean reversion. So what I mean by that is, say there's growth is one of those. So what we're doing there is buying stocks that grow faster in terms of earnings than other companies. The expectation is that you'll also be able to get performance in terms of you'll get better performance in the long term because their earnings are growing faster, and so therefore the share price will go faster. The assumption is it's not going to mean revert. So I'm buying a growth company today, and the company's growing well. It's not going to stop growing next year, and it's not going to stop growing the year after, and the year after that. So that's implicit, and that's so as you're buying growth stocks, you need to be looking at each stock and trying to work out, have I got the wrong stock in here, because they're the ones that actually really hit your portfolio, in that a growth stock might be trading on a quite a high valuation. So say it's trading at 30 or 40 times earnings, and then one day though it stops being a growth stock and it starts and everyone starts looking at it as as just a normal stock, and it goes from trading on 30 times to sort of 15 times earnings or lower, sort of more like a market average. And so straight away that's going to halve your share price. But the second thing it usually does as well is the growth has actually stopped. And so analysts might have been expecting the company to grow at, say, 20% next year, and all of a sudden they're like, oh no, it's not going to grow 20%. It's actually going to grow at 0. And so first of all, your earnings falls by 20%. And then the premium that's going to be added falls by another 50%. And so growth stocks that go ex-growth are the very dangerous part of that portfolio, and where you see a lot of price swings around. So you've got growth. Quality is another measure, and what we're looking for there is companies that are generating above average returns. So ideally, in a holistic sense, you're looking at companies that are reinvesting money, and as they're reinvesting that money, they're getting a very high return on that. And so that means their earnings are going to grow faster, and they've got quite high margins, and so there's safety, and they don't have a lot of debt, and so there's that sort of safe aspect of you're getting a high quality stock that's going to do well over time. Again, no mean reversion. You are buying a quality stock, and I think it's still going to be a quality stock. Then we've got these low volatility stocks, which is sort of an interesting one. I'll go into more detail about it later, but basically it's stocks that don't have a lot of volatility, or even if you in terms of putting it together in a portfolio with other ones, it generates a portfolio that doesn't have particularly high volatility. And again, the concept there is that that's not going to mean revert, that they'll stay low volatility. And then momentum is the sort of the fourth of the 5, where stocks that are going up are going to keep going up, and stocks that are going down are going to keep going down. And so again, that no mean reversion. The one that does have mean reversion is your value measure. What you're effectively saying there is, I've bought a stock that's cheap, and it's not going to be cheap forever. It's going to revert to a more normal, maybe an average, or even just I've bought something that's very cheap, and it's going to revert to just being a little bit cheap. And so so different strategy. And what that means is that the other 4, you're expecting to sort of generate you more regular returns, whereas a value strategy is sort of almost by definition goes under this part where it sits in, because it's not assuming mean reversion. It goes through some quite long periods of underperforming, and then all of a sudden makes all this money back in a particular time. And that's one of the strategies that's value has worked particularly well so far this year, after a very, very long period of drought. So we'll dig into again that a little bit later. So 5 different strategies we'll look at, I might jump
Damien,
to. Oh, sorry.
Damien, could you just give our listeners, maybe a couple of examples of each of, a momentum stock, a growth stock, just so they've got a bit of an understanding?
Yeah. So well, a momentum stock is just a stock that's going up. So it's a.
Yeah, I mean a specific example. Maybe if we've got some in the portfolio or.
Oh, okay. So right now, you're well, depends on what your time frame is, but oil stocks at the moment have been sort of sitting, very much in terms of the as momentum stocks at the moment. You'd got Apple's been a relative outperformer. Some of the healthcare stocks at the moment, so something like an AbbVie or United Health has been an outperformer, and so on a momentum basis sort of sits in a portfolio. In terms of growth stocks, you're talking mostly the tech names. Your top names are your Apple, Microsoft, Amazon. Your FANG stocks, so sit in that. And then your value stocks tend to be stocks that are more like your say your healthcare stocks, the banks and oil stocks make up a decent chunk of them. Something like a Berkshire Hathaway sort of sits in there, or some of the consumer staples. So yeah, that sort of sits in the value categories.
Nice one. Thanks for that.
At the moment, yeah, and these things do change as well, which is, and especially the momentum that changes. But yeah, we'll dig into that in a minute. So I've got a chart that Sam will bring up on the screen, which is looking at the factors so far this year. And what I'm looking at here, there's a whole bunch of different ways to look at these, and I'll show I'll show some other ways in a minute. But this one's basically it's what's called a return spread. So we break everything up into 5 categories or quintiles, and we look at what did the top category do versus the bottom category. So, for example, in terms of valuation, we say you break everything up into valuation, and there's a few different valuation measures. But what did the stocks that were the cheapest do versus what are the stocks that were the most expensive do? And it's a subtracting of the two. So on the chart here, what we can see is in terms of value so far this year, value's been this particularly good performer. So particularly in January and April, January sort of 8% between the two categories. April was sort of almost 12%, and so that that's sort of very much been the story of this year so far. Hasn't been as good so far this month. It's actually the worst performer so far this month. Part of the reason for this really is that this is a strategy that is quite heavy in oil and energy, and that's so it's really been an oil-driven story, and a little bit banks as well. In terms of some of those prior months, as longer term rates started to go up and the yield curve steepened, that sort of helped to benefit the banks. Now, as we've sort of seen yield curve flattening, it's starting to go the other way for banks. Price momentum. I actually I'll go more into price momentum in a minute. The other big one is this volatility factor. And unfortunately, I've got this from Capital IQ, who sort of reverse it in terms of these. So it's actually what it's saying is the highest volatility stocks actually had a shocking June and a shocking April. It's actually the really low volatility stocks that did quite well in those months. And so that's sort of been the real key factors so far is looking at the volatility and looking at valuation. So if you've been in stocks that are cheap, and stocks that are not particularly volatile, and there's a little bit of crossover between those groups, but there's actually probably less than you might think. Then that's been the best strategy so far this year. We'll move on to what the better strategies later on, and later on we'll start talking about what the better strategies are. The other thing I just sort of want to talk about in terms of quants is some of the things that can go wrong with it. It's if you're sort of running these quant models, resources, utilities, financials often have this problem that the quant factors that you think might work give you the wrong answer. So say in resources, quite often when stocks get really cheap, it's because metal prices are really high, and everyone from a fundamentals perspective is looking at it and saying, okay, yeah, maybe the iron ore price is $200, but I think the long term price for the iron ore is more like 50. And so if I'm looking at a stock that's earning $200, I'm not going to pay 15 times earnings for it. I might only pay 6 or 7 times earnings for that stock. And then when the price falls though down to $30 or $40 for iron ore, at that point people might be looking at it and saying, well, actually, you know what, I will pay maybe 30 times earnings for that. So because I think that price is not going to hang around forever. And so there's this you get sort of the reverse issue that you have in some of the other sectors for some for resources. Financials, often their numbers are different, and sometimes some of the ratios that people use just don't work as well for financials. You've also got some issues with sort of manufacturing versus service companies. So, in terms of everything we're sort of looking at, we're always trying to work out where does this company generate its cash from. And if you've got companies that sit on these massive assets, so they own like let's say in the oil services sector, you might have one person who owns some big drilling rig, and effectively they're like a landlord. I own this drilling rig and I'm leasing it out to people and trying to make return on it. Versus somebody in exactly the same sector who's got a whole bunch of engineers and are outsourcing those engineers to these energy companies to do whatever in terms of that. The guy with the services has almost no capital at all. All he's got is a bunch of people there. Whereas the manufacturers, the guy with the rig he's all capital and almost nothing else. And so the ratios you get can be really, really different between those two. And you just sort of need to be looking at the quant methods you're using and trying to work out, well, have I just got a model that buys services companies because that's the way I've set it up to more benefit companies that report in that way, or vice versa. And so that's sort of some of the things we sort of need to watch for. The other one then, so we spoke a little bit about the things that are working well at the moment, or has worked well so far this year. I just want to put that into context of longer term returns. So I've got another chart up just sort of showing the year by year returns for these strategies. And so the value strategy, which again is buying the cheapest 20% of stocks and selling and shorting the longest, the most expensive, would have got you so far this year 20% return. Which is obviously a very good return. And so this is an absolute return in terms of what it's clicking. But I just want to note that it's actually been one of the worst strategies over the last 10 years. So you can see in 2020, you actually sort of lost 26% on that same strategy. Numerous years in prior, 2018, you lost almost 10%. 2015, you lost 17%. It's sort of like been a number of years where it's been the worst performer in terms of strategies over the last 10 years. And so much so that there's a lot of discussion in the value sector about what's going wrong with the value factor. This year's come roaring back. A lot of it though comes down to the oil price and how much that sort of falls into it. So we'll get into that in a minute. The other thing is the volatility of buying stocks that aren't particularly volatile. This is reversed. So this is talking about volatile stocks have had the worst performance. So minimum volatility is actually it's been a good strategy, but it's in this year. So buying the least volatile stocks been a pretty poor strategy the last 3 or 4 years, but it's actually been a very good strategy over a long in the period before that. For maybe 15 years before that was a very strong performer in terms of the strategy. So yes, that's and the other one I just highlighted is earnings quality has probably been the most consistent over the last 10 years in terms of buying stocks with good earnings quality. It's generally a good investment in low return periods, and so that's one of where we're sort of expecting to go back to that. And so it's one of the factors, that earnings quality side is one that we've been focusing a lot in terms of the stocks we've been looking to buy.
Why valuation stocks have performed so poorly, and minimum volatility has done well and earnings have done well? Because
you need to look at things on more than one axis. So I guess the thing for me is I'll use the example. Let's say we're going to buy a mattress. There's there's one thing about value. So value is the only thing you care about when you're buying a mattress. There's mattresses sitting out there on the street. You can go and pick them up for free. Take that home. That'll sort you out. You bought the cheapest possible. You hadn't had to pay anything for it. Just your effort to lift it off the curb and bring it inside. And most people will go, well, yeah, okay, I might like a value mattress, but I don't want it that cheap. And then the next stage, you're like, okay, well, you can buy something that the big, a fold-out mattress with a big bar in the back, and you got to spend. You save yourself $100 or $200 on your mattress, but you now you got to walk around and go to a chiropractor or you got problems with your back. And then you start moving into okay, now you've got an acceptable range of mattresses, and at the far end of it, you can buy, you can spend thousands of dollars buying the world's best mattress, and hand woven by whatever, just and diamonds encrusted, or at some stage, and you sort of go, okay, well, that's spending too much. So on the value factor, for us, what we do is we do value relative to quality. Is the key thing for us, is saying, well, it's a question of how much quality you're getting and then how much value you're paying. So, I might take an average quality mattress, but if I can get it for free, fantastic, I'll take that. But if I'm looking at average quality mattress for $3,000, I'm like, no, I won't buy that. But at $100, I'll take it. So it's the idea about what are you getting for what you're paying for? And that's part of the issue with the volatility stocks. Is the volatility stocks performed really well. Some of it due to falling interest rates. Some of it due to, it's actually an interesting strategy that wasn't sort of that just wasn't a major factor in people's what they looked at back in the sort of early 2000s. And then it became this really popular strategy, and so it performed really well for sort of 10 years. And as a result, the stocks in it got really expensive. And so you're looking at this minimum volatility strategy, and when you looked at it, you're like, well, I can buy the stocks with a minimum volatility, but actually what I end up with is a stock is a portfolio of quite expensive stocks with minimum volatility, because all these other quant funds have been buying them and pushing them up. And so then you had a few dud years in 2019 and 2021 in particular for that strategy. And so which sort of brought it back more into line. And then we've just had this massive outperformance of this thing again now. And so now it's starting to get to the stage where it actually looks a bit expensive. And actually, that sort of segues nicely into this next chart. So this is the minimum volatility index, the MSCI one. So this is MSCI is largely thought of as the for international portfolios, is largely thought of as the index to look at for these. Not to say though that these are the only way. There's actually a number of problems that with the way MSCI put these together, and they're usually quite simple in terms of the way they do it, and so and sometimes that simplicity sort of works against them. So I'll dig into that a little bit more detail, but. And so what this one's looking at is, so we can see this minimum volatility. You can see this over the last 10 years. You started in 2007, and it sort of the blue line's above the yellow line for most of that time period, and really got high sort of pre December 19, and then actually it all caught up recently. And so now you actually gave up most of your gains in the last in sort of 2019, 2020, 2021, it underperformed by so far that it's sort of caught up, and then in the last sort of 6 months or so, it's started to open up a little bit of a gap again. And so I guess the question for people is, okay, minimum volatility is a strategy where it's sort of interesting in that if you get a lot of stocks that don't fluctuate very much, that actually gives you a good return, a better return than you expect, because the sort of pure theoretical version is that for anyone who's sort of seen the capital asset pricing model, or CAPM, is that if you take more risk, then you get more return, is the idea. So I buy equities, and because I buy equities, I get a better return than if I bought bonds. And if I buy bonds, I get a better return than if I bought cash. And if I buy and so that's the idea that works sort of at a top level. But interestingly, within stocks, if you put together a portfolio of stocks that are quite low volatility, that's actually been an outperforming strategy. So it's sort of like the opposite of what the theory would say. And so some of that some of that is some portfolio analysis. Is basically, you can find stocks that are negatively correlated and actually put them together and get some benefit from that. But some of it is that it's just and some of it, sorry, would also be that we've seen lower interest rates over time, which sort of biases towards this. There's also a question with diversification, and size. So if I'm buying stocks that are not particularly volatile, chances are I'm buying bigger stocks, and I'm buying more diversified stocks. And so there's there's always these questions with when I'm buying something, am I getting the return because there genuinely is something special about minimum volatility, or am I actually just buying diversified big stocks that benefit from falling interest rates, and is that actually what's driven this minimum volatility? So I'm looking at one factor, which is the volatility, and what I'm really getting is a mix of these other factors sort of built into that. And the other thing I'd say is that companies that don't vary their earnings very, very much are often good companies. Not always. Sometimes it's because they're dodging their earnings, but companies that have quite steady underlying earnings are quite good companies, and are often quite good companies, and that often means that you can get better returns in that. And so some of that might be this. And the final thing to note on it is that on the minimum volatility strategy is that it does take a bit of trading. So not as much as a momentum strategy, but if you're in these strategies, you do need to be. It is something that can change, and the stocks within it. So you get these reversals where I bought this stock because it's low. It's got low volatility, and if a whole bunch of other people have done the same thing, and then all of a sudden it has an event which increases its volatility, then I've got to kick it out of my portfolio. Every other person sort of chasing a minimum volatility strategy also has to kick it out of their portfolio, and that happening can then force other people who might not have hit that same limits, and so you can turn minimum volatility stocks can when they go the other way, if they're overbought by people, can actually sort of end up similar to that thing I was talking about, growth stocks, is about when they go X growth. It's sort of similar with minimum volatility stocks when they go X minimum volatility. The next strategy is this idea of a momentum. Now, I sort of speak about this as the dumbest version, but it actually, it works really well over long periods of time. So, and the idea is you basically buy stocks that are going up, and they generally keep going up. And so, and then once they start going down, you sell them, and with the idea that they'll probably go down for a longer period of time. And a lot of this is, basically similar to technical analysis. It's Having said that, though, I guess the thing I would highlight for this type of strategy is, first of all, the trading costs are really high. So this is a momentum strategy. If you put in some of the trading costs, often this can blow the returns out of the water. Secondly, this is a classic. I think I noted one of the comments from Joe sort of talking about picking pennies up in front of steamrollers, and this is absolutely classic in terms of that. I'm buying stocks that go up, and I'm holding on to them while they keep going up, and then all of a sudden, though, they gap down, and I actually missed my chance to get out, and so I might have made money, and then all of a sudden lost a lot quite suddenly. And then in choppy markets, that's the other place where you can lose a lot of money on this strategy. So that's where we've been so far in. So that's where we were last year in 2021, and to a lesser extent in this year, but certainly so you can see on this chart I'm showing here, the 1 year performance. You've done about 4%, 3% less strategy than what you would have done just buying the world index, and last year you probably did more like 7 or 8% worse than what you would have done owning the index. And that's because this sort of relies on relies on quite steady trends. When you start going into markets where it can swing around, momentum can really hit you. And as I said, the trading costs are really high. And if you're following momentum strategies, sometimes that, especially if you're doing it yourself, sometimes that means you can, from a tax perspective, you actually get classified as a trader rather than an investor, and that's got its own problems with it. And the other thing on the momentum, the fundamental for me though behind momentum is that nothing sort of moves in absolutes. So the idea is that, say Apple produces produces this new iPhone and it sells really well on day one. And so the share price goes up a bit and the earnings sort of, the management's like, hey, things are looking pretty good. Then on day 30, a month later, they're like, oh, actually this phone's still selling really well, and so then the share price goes up a bit more and the earnings go up a little bit more, and then 6 months later they're like, yeah, this has been a great phone, it's really worked really well. And so it's this idea that while things might be better, the market doesn't immediately jump into price these as if things are great from day one. And there is this sort of constant feedback loop of things that are going well for a company. Often, they become a market leader, or there's a theme that's sort of chasing it, which is might be buy resources or something like that, and that theme might run for 3 or 6 months. Is that if you're onto that theme and following it, you can make some money from it, regardless of whether there's truth behind it or not. So that's where the momentum sort of factor comes in my view, is that there's some of it's just sort of pushing that whole market. What's the market doing? Yeah, I'll just follow what the market's doing and hope that I'll be able to find a seat when the music stops, and not be the one left sort of holding it. So you make lots of little wins on this strategy. The problem is then you make some big losses that sort of offset it. So a lot of it's about avoiding those big losses. For me, I quite like looking at the momentum, because it's trying to work out what's it telling you. I can see some smoke. Does that mean there's a fire, or is a fire almost out? And so, I find it not something I follow in terms of momentum sort of chasing, but I do, not something we invest in our portfolio just because of the high turnover and a whole bunch of other issues. And, this issue of small gains and big losses is sort of like the opposite of what we want to try and do. But it is very interesting to see what are the momentum stocks, and is there something behind it? Is there something we've missed? And especially on the negative ones, is it, okay, here's a stock which has got negative momentum and we own it. Is there a fundamental reason for it? Is there something worse than what we think? Do we need to go and look and reassess our assumptions a bit more? The value performance is so that's been the great performer this year, but terrible performer over even with the great performance this year. You can sort of see that it's still sort of 50% behind over the last 15 years. So yeah, 15 years of performance, and you're 50% behind just buying the world index if you just bought the cheapest stocks. Some of that's the reason, the way they put it together. So I have sort of issues in terms of it relies a lot on book value, and this is the MSCI one in particular. It doesn't have any cash flow measures in it. If you do some of the cash flow measures, value is done a lot better if you sort of focus a bit more on cash flow, which is what someone like ourselves would do. The MSCI one, so there was a book written sort of back in the almost a century ago, looking at some of the factors, and it grabbed upon this idea of book value as being really important. If you could buy a stock for less than its book value, then you're doing really well. And Warren Buffett, sort of follows a lot of these. The issue is book value is no longer what it used to be. And I'm not saying that from a, things are so much better now, or things used to be so much worse, so much better before. It's actually that accounting standards have changed. And so there's no longer so to give an example, so if I have a book value, say of $100 million, and I'm generating $10 million of cash, and I've got this every year, and that's my asset. Pandemic happens, and say I'm in the travel sector or something like that, and I look and my cash flow is now negative. I have to go and write down the value of that asset. So I follow through the accounting rules, and I go, okay, I've got that asset worth $100 million on my books. It's now not earning anything in terms of revenue. I think I'll be able to get something back, and I still own some whatever I own. So I'm writing that down from 100 million back to $20 million. And that might have happened, in 1920, and then they had pandemic back then, or it might have happened in 2020 when we're having a pandemic. Then afterwards, though, things bounce back, and I start making my $10 million again. Under 100 years ago, yes, you go back and write your book value and go, okay, yep, I wrote it from 100 million back down to 20 million. Actually, no, it's back to 100 million now. Nowadays, that's much harder to do. So once I've written it down, it's written down, and so you lose some of that. Plus, there's a whole bunch of other issues with it, other changes with accounting standards. But the net effect is when you look over time, you're not comparing with like with the like. And so this sort of value index has this predisposition to be buying stocks with good book value, and what that ends up doing is buying lots of energy companies and lots of banks. And so if banks and energy are doing well, then like they have over the last 6 months, then this strategy does well. If they're not doing well as they haven't done very well over the last 15 years, that's where you end up being sort of 50% behind the market over a longer period of time. So so for me, the value strategy, it works at particular times. It worked great in 2000, which is sort of where it got a lot of picked up a lot of kudos. It didn't work so well in 2008. Worked terribly the last 15 years, except for the last 6 months. And so for me, it's about very selectively using this sort of value strategy. And if you define the numbers a bit better, it does work a lot better. But you need to be quite careful as to how you're using value. You do want it there to sort of save you when markets are falling, but it's important to know that I'm buying the right things. I'm not ending up with just lots of banks and energy stocks, which might do well for quite short periods of time, but it can actually also do really badly if you do have a big downturn.
So he's asking about how does Berkshire Hathaway track to these strategies? And Buffett's obviously a value investor, and has he underperformed relative to this value strategy?
No, so and then this is the one I like. I actually think Warren Buffett's not as much of a value investor as he says he is. He's more of a quality / value investor, which is sort of similar to the space we're playing in. Because he's always questions about what's the return you're getting for that price. It's all about yes, there's a lot about value, but I don't think he's overly concerned about book values. He will incorporate more about cash flows and other things. And the other thing is he talks about the margin of safety. And the margin of safety is this reflection back to and wide moats. And a wide moat is a high quality company. So I guess what he's sort of saying is that if I find a high quality company, I'm happy to buy it, even if it's a bit more expensive, because I know that quality will keep going and carrying me higher. And so as much as he gets sort of touted as being this value investor, and this is why you should invest in value, on a broader look, for me, he's very much a quality / value. I will buy something at the right price. And if it's which is we sort of follow within ours. I'll show our matrix a little bit later, but we're happy to buy high quality companies at an average price, and we basically sort of sit them there, and they're the ones that sit in our portfolio, and we want to sort of own them forever, so to speak, unless they get horrendously expensive. Whereas their stocks will stick in there. One we had the other day, we put Bridgestone into our portfolio because they got smashed when the oil price initially rose, and that oil's a big component into tires. It's not a particularly high quality company. It's a pretty average quality company. There's lots of other tire manufacturers, but it was really, really, really cheap. And so we bought it as cheap. It went up by 20 or 30%. Oh, okay, that's enough. We're out. Whereas if we're buying, say, a Microsoft or something like that, we're buying it because we think it's going to keep generating. It's a high quality company going to keep generating those returns. We'll just sit it in our portfolio and hold it there, effectively forever. So, unless it gets really expensive. So I wanted to break. Actually, I did have a chart as well just to illustrate that. There's a chart up for anyone sort of listening in and can't see this. I've got the value factors sort of broken up into what this is just from Capital IQ, just what went into that value numbers, and the one I just want to highlight in there is there's a free cash flow to price, and so that's your cash flow measure. And if you sort of follow that one through, that's done way better than all the other ones. So, in 2015, when everything else was down sort of 15, 20%, all these other factors, it was up by 5%. In 2020, when all these other value factors were down by as much as almost 40% for some of these, a lot of them are sort of down 30%. It was down 2.5%. So just showing that not every value factor is the same. And so and they'll all have their periods of going through different different periods of success and failure. And that's and for me, that's the MSCI ones which you see don't. I just want to highlight the MSCI value index that most people use as their sort of benchmark or look at and talk about, doesn't have those cash flow measures in it. They're absolutely there. Lots of people have licensed them as ETFs. So if you want to buy the MSCI Quality Index or the MSCI Value Index, the world indices are quite easy to buy. If you're looking at the Australian versions, there's a couple of them in Australia. And if they're not ETFs, there's usually funds. So you can buy like a managed fund that tracks it. The ones in Australia, I feel like there might be a quality and a value, but once you start getting into some of the others, I don't know if there's a momentum. Like whereas the world ones, you can feel whatever you want. But the quality, if you're just looking for Australia. And the other thing is the Australian one, the market's not that big. So let's say that the MSCI Quality Index for Australia is taken from there's about 60 stocks that go into that index, and so you're already really heavily overweight banks and resources and energy, and so the values index just doesn't end up being that different to the overall index, for that reason. So so the things I'd want to highlight is with value is superficial value is what I sort of call it, is not the same as value in my book. You want to try and dig into some of the more important measures like cash flows and others. Use it like a tool, like a lot of the valuation, not a religion. So what I mean by that is there's a lot of, because value doesn't perform that well for a lot of the time, and then it does perform well. There's a lot of, what I would call, high priests of value, and they pitch it on a belief system, So and they'll refer back to the call to authority of Warren Buffett, which is why he's widely thought of as value, and they'll just talk about saying, you just got to have faith, Sam. Yes, we've had bad performance for 5 years now, but just have faith; it'll all come good. We'll make it all back. And then in times like now, you're like, oh look, it's raining. I told you it was going to rain. I did my chance, and now it's raining. Isn't it fantastic? And you're like, well, yeah, I'm still down 50% over the last 15 years, but yes, I had a one-off win. So so I like value, but for me, it's a trade-off. Pick your other factors and then use value to get another factor, and just be careful of those. The religious part of it, which is the high priests of value who will keep telling you got to have faith, just stick with my religion, but yeah. And so, and the other thing though is, remember though, it is very different to the other ones in that every other strategy, as I said, is assuming that I'm buying a quality stock, it's going to keep being quality. I'm buying a growth stock, it's going to be growth stock. Whereas value is actually the opposite. I'm buying a cheap stock, and I'm assuming that it's not going to be cheap forever. So yeah, if I don't want to overuse the mattress one, but I've picked up a mattress off the side of the road, and it's still free, and I can't get anyone to pay for it, but I'm getting it because I think somebody will pay me something for it at some time in the future. And so it might be true. Might be a mattress shortage, and I can flick it on, but that may or may not be a good bet that my mattress I picked up off the side of the road, I will be able to sell for a higher price. Growth. So growth, this is a sexy sector, obviously. This is where you get all the Teslas and all those types of companies sort of come into this growth bucket. It's had a pretty decent couple of years. It's the issue with growth, and sorry, actually, to take one step back, it's had a pretty decent couple of years over the last 5 years, or great couple of years over the last 5 years. It's had some really big blow-ups, and the tech boom is one in particular. Potentially we're going through a similar type of blow up at the moment. We're certainly, growth has been the worst, one of the worst performing sectors so far this year. Having said that, growth to me is all about what's priced in. So it's this idea that if I'm buying a growth company, it's fantastic, but does it mean, and I've got a company that's just growing at, say it's just growing at 30% per annum, year in, year out, growing 30% per annum. Okay, does that mean that I want to pay and say it's earning $1 of earnings? And I might look at it and say, well, if I pay 15 times that, so I can buy it for $15, fantastic. I've got this stock growing at 30% per annum. I'm buying it on a 15 times multiple, happy days. And then I go, okay, well, now how about a 30 times multiple? I pay 30 times. I'm like, oh, maybe I would. It's twice as expensive at the market, but it's growing every year. So I'll buy it now. It looks expensive, but in a couple of years' time, it won't be expensive, and I'll be happy I bought it. Okay, what if I want to pay $1,000 for it, or $10,000, or $20,000? Okay, I'm buying $20,000 for a stock that's making $1 worth of earnings and growing at 30% per annum. That's great, but it's going to take a hell of a long time to actually make it worthwhile for that $20,000 I paid for it. And so that's my part with the growth, is always coming back to, yes, I want growth, but I don't want to pay too much for it. And the argument is that if you're buying growth, 6 or 12 months ago, you were paying too much for it. And in the tech boom, we certainly saw the blow up of growth. There's been numerous periods where you've seen people overpay for growth and then end up with a bad return from it. So at the moment, and I've got some numbers up, Alexi, on these the bottom right shows some of the fundamentals for the MSCI world growth at the moment. So you're paying roughly 21 times forward earnings for it at the moment versus 14.5 for the world. So fair bit more, or 50% more basically for these. That gap's been bigger. Certainly 6 or 12 months ago, it was a much bigger gap between the two. So you're not paying as much as you were before, but it's still a reasonable size gap, and it really comes down to which of the stocks you're buying for it. So sometimes something like say Meta, the Facebook, still sits in this depending upon how you're measuring it. But it might be trading on 12 times PE. So you might be saying, well, okay, there's one stock that's growing, or do I think it's going to keep growing? And have your arguments there. Versus a stock like an Nvidia or something that might still be trading on 30 or 40 times earnings. And so it's a question of where am I getting, how high is the growth, and then is that justified by how high the price I'm paying? And the problem, despite growth has done really well over the last few years, over the 20 years before that, it wasn't a particularly good performer at all, because people tended to overpay for growth. And so it's one factor. We tend to throw that into our quality matrix, and we certainly want to look at growth, but not at the expense of anything else. MSCI growth, one of the main things I've got problems with MSCI growth is it doesn't have any cash flow measures. But the other big one is it's got this over reliance on what they call analyst long-term growth, and I think it's about 70% of the actual measure that they use. At brokerage firms, the people who upload this couldn't care less about what the long-term growth is. They'll upload a number as a bit of a marketing stat. So their main focus is on what's this year's, or this, if you're in America, what's next quarter's earnings going to be, and maybe this year's earnings. Most of the rest of the world is focused about what's this year's earnings going to be, and maybe next year's earnings. This long-term growth figure is like a 5-year out long-term number. They just don't care about what that number is, and it's more of a marketing tool, and it's not a factor in a lot of their models. And so and that's one of the key factors that MSCI uses to assess whether a company is going into the portfolio or not. So as I said, everything's, once you dig into it, questions about well, certainly the MSCI ones are quite simplistic about how they're put together. So so the quality index is the next. Quality has had a very good performance over the last 15 years. As you can see from here, it's been a pretty steady performer most years. This year, it's been a little bit of an underperformer, sort of down 3%-ish versus 2% versus the rest of the market. But overall, it's been a pretty good performer for a long period of time. I guess there are some questions about how much you pay for that. And at the moment, you're not paying that much more for it, for the quality. so yes, you're paying 17 times for these quality stocks versus 14.5 on a forward basis for it. There is some issues. I've got some issues with the way they put together these quality indexes, which can vary it. So I've got an example of what MSCI does. Is I've got a chart here of so MSCI use return on equity as one of their key factors. And so I've got the IBM return on equity here from 2006 to 2016. And if you can't see the graph, it basically grows from the 2006 it was 20% return on equity. By 2016, it was earning 100% return on equity. So to put that in perspective, what that ratio is telling you is that for every dollar they invest in that company, they make that dollar back the very next year. And that certainly wasn't true for IBM. It looks like it's true from this measure, but it certainly wasn't true at all. And then you can see the ROE falling back down over the next few years. But actually, what was happening was they were doing some massive buybacks and reducing their capital. They were turning themselves from a manufacturer into a service company. And so I won't go too much into the details of it, but basically the net effect was they had this equity figure in their balance sheet that really didn't bear a resemblance to what the real equity was in the business, and then had some write downs, and that's a common effect right across the investment landscape. Is that and I spoke before about this idea of book value and equity is effectively book value. Is that it's not the same as it used to be. You've got these issues with write downs. I can if I had that company, I'm a company that's got $100 million of equity and I'm making $10 million of earnings. So I've got a 10% return on equity. If I take a write down and I write down my equity the very next year by half, I've just doubled my return on equity. And so am I better as a company because I've taken the write down? I'm still the same company. I'm still generating the same cash flows. There's no difference. But it's that idea that, equity, you need to be a bit smarter about the way you generate these equity figures, and so that's a key flaw. And the other main problem I have with this index as well is they put it together by they have combining the Z scores. This is the direct one. They combine the Z scores of three Windsorized fundamental variables: return on equity, debt to equity, and earnings variability. Windsorizing is a fancy term for basically if I've got outliers and I just ignore them because they'll throw my model out. The earnings variability is a I think this is a regression measure. It's correlation or a regression. I think it's a regression, looking at the error on a regression or something like that with 5 data points. And so, for anyone who's done any statistics, 5 data points, you would never do anything on such low numbers. So there's a number of things that go into it that really don't add up. But the idea of buying quality stocks and stocks that don't have lots of debt to equity, such as earning high returns on reinvested equities, is key for us. That have a wide moat in Warren Buffett terms and low earnings variability. All those factors are good to have. And so, quality stocks, which is why quality stocks have done quite well over time. Yes, that sort of leads back to, I spoke a little bit about our quality versus value metrics. And so that's where, I've got a chart, which I've got up there, but it's basically quality on one axis and value on the other axis with cheap and good quality in the bottom left-hand corner and expensive and poor quality in the top right. And we're basically trying to buy stuff under the curve. And there's, this is a simple version where it looks like everything comes out on one axis, but there's so many more factors beneath it. And how have you adjusted for, say, if there's a company that was actually quite a good earner, but then the pandemic hit and its earnings fell by 100% for a year and then bounced back a year later, but it's been really steady since then. Do you treat that as a highly variable company, or do you treat that as a very good one? You just ignore the one, or is it somewhere in between? And so a lot of those factors, really mess with these models and as to how they're brought out. So there's a bit about what do you want to buy, but then also I'll just sort of highlight some of the stocks that are in there. So actually, before I highlight the stocks, I might actually go to the outlook side of it. Is that it really depends on what type of economy you're expecting to be living in. If you're of the view that, look, inflation's runaway inflation's here, it's gonna keep going up. Central banks will be raising rates but not fast enough to pull it back, and we're in this period of rising prices and heading for stagflation. Then there's still value is probably got more to run if that's the case. One is, it's probably going to be the case if that's your outlook. Oil price is probably still going to be going up, and it's heavily exposed to energy. Value stocks tend to be the stocks that don't have a lot of pricing power. So in a normal sort of low inflation environment, they have to rely on sort of keeping prices steady because they're usually low margin businesses. They've got to keep prices steady and try and generate sort of cost savings on the back end to actually sort of keep their profit growing. When you've got high inflation, a lot of these companies can finally raise prices. They finally have enough scope to rise prices, and that's why that's one of the reasons why value sort of performs in that environment. If you're more of the view though that inflation's sort of peaked or close to peaked and was largely driven by supply chain factors, timing issues with people buying more goods and services, and both of those are coming to an end, and then sort of exacerbated by the Russia invading Ukraine, and it's a matter of waiting for that to come out, and that we've seen rising interest rates, which are going to smash demand. Then value is not the place you want to be. That's where you're probably going to see some of the poorer performers. And if we're going back to the same environment we were over the last few years of quite low demand and if central banks having the problem they haven't got enough demand, then value is not where you want to be. You want to be more into quality stocks and maybe growth at the right time. Growth is probably going to. So I've got the value stocks there that you can see. I've shown the growth as well on the same part because often they're sort of thought of as opposite ends of the same or opposite sides. If you're a value stock, you can't be a growth stock, and vice versa, just to a certain extent. What was I going to say on that one? And so if we're going into this, if we're going to this downturn, you'd expect that the growth stocks are actually going to be the ones that are some of the hardest hit by it. But they're the stocks you want to be buying when you can pick them up at cheap prices. So the question for these is saying, well, how low does it go before you say that's low enough? And actually, I do want to start picking these up and putting them into the portfolio because you'll benefit coming out the other side. What do I want to highlight? So you can see in the growth portfolio, we're saying you rarely find stocks that are in both. Meta is an example of one that's in the growth portfolio. It's not, you can't see it in the value portfolio for this one, but there are other value portfolios, other people who run value metrics who are starting to put Meta as an example into that growth portfolio, into the value portfolio. And the question is now, will it fall out of the growth portfolio as it does so? Then I've got 4 other factors. So quality, minimum volatility, momentum, and ESG. Now this was all as at 30 June. So sort of it's only a week old, but I guess I just want to highlight that with a minimum volatility can be a little bit high turnover, and the momentum can be really high turnover. So just because it's in there a week ago doesn't mean it's in there today. But you can see, say, Johnson & Johnson actually sits in every single one of these portfolios. Plus, it was in the value portfolio as well. So it's a show that not every getting pure exposure to one factor is very difficult. You've got here Johnson & Johnson in of the 6 different factors we have here, it's in 5 of them, and so it's not always. I guess what I'm saying is it's very hard to get a pure exposure, which is why quant funds like to run quite large portfolios when they're doing this. So so for us, it's about saying growth. We're not ready yet, but we are certainly trying to look for names in the growth sector that are being smashed, and we can pick up at a price where we think it does the actual growth does justify it. Quality is probably the key part where we're focusing on. Minimum volatility, we had towards the start of the year, we were getting more, we were sort of a bit more focused on volatility, a bit less now just because it has performed well. And so as the stocks in there are just getting a little bit more expensive. I felt as if minimum volatility just got really expensive over the last 3 or 4 years. It sort of fell back then. Over the last 15 years got really expensive. Over the last 2 or 3 years, it actually fell back to almost a reasonable level, and now it's starting to get expensive again. So volatility for me is a factor I'd like to have, but not at the cost of paying too much for it. And momentum's a hard one. That's stuff's in and out of there all the time. I guess for mine, I'm quite wary of a momentum strategy at the moment, just because we are in such uncertain times, and you could see you can see lots of reversals from month to month, and that tends not to be good for momentum strategies when you're in that type of environment. So I won't leave it at that, Sam. Unless you got any other questions.
We've got a couple of questions coming through. There's been lots of comments today. People find this of real value, so it's good to do a bit of a deep dive on this. So Jude's asking, what's the outlook for Aussie bonds in the portfolio? They seem to be slowly coming back, and what's Nucleus team outlook there?
Yeah, so we're certainly looking at that as one of the best places to be at the moment. So we've gone quite long term on the bonds that we're holding, and our view is that they've probably peaked in terms of the prices, and that if things keep going the way we're expecting, and you don't see any further major shocks to the world economy, then those yields coming back in. So even pricing, I mean, I think we might be getting close to the high sixes in terms of the peak now for maybe it's still 7% for the peak of mortgage rates that's priced in by the market. And so if you believe that's going to be needed to sort of cut back on inflation, then bond yields are about the right price. But for us, that's way too high, and that given the indebtedness of the Australian economy, that 7% interest rates are going to smash the Australian economy, and it will be in quite a deep recession at that level, which means they either can't go to that level, or if they do go to that level, they'll be heading back quite quickly after that. And so so our take is still bonds is a great place to be. What else on that front? Yeah, and that also depends. That also determines a little bit your the stocks you're buying. So the question in terms of bonds are if bond yields are falling, then that lends a little bit for growth. As long as you don't see the economy rolling over, and that's the other factor on which we are expecting to see that economy rolling over. And so buying growth stocks right now, unless you're pretty confident that they can handle a recession, might be a bit early, or they're cheap enough that you sort of I'm buying them now at X dollars, and I don't mind if they go down to another 20%, because I think they'll be double that in a few years' time. There's a few stocks like that, which you just sort of go, well, you just can't pick up these stocks at cheap prices almost ever, and so if they do get cheap, it's worth looking at. So on that front, it also meant that if you're looking through utilities, so the more defensive sectors, utilities, consumer staples, and real estate investment trusts, is you sort of more, if you think bond yields are falling, you're more predisposed to those sectors, as long as you're looking at it and saying, well, say for real estate investment trusts, there's been this explosion in warehousing and supply chain and all that type of stuff, and demand for it is saying, well, if I'm buying that because I want the yields to go down, but at the same time, these warehouses are starting to they're no longer needed. Everyone's built out all their warehouses, and now they're actually trying to pull back on their inventories a little bit. Then your earnings could fall far enough that the bond effect is overwhelmed. So it is a matter of picking the ones. So for us, the example of one of our largest holdings in that area is the American Tower Corporation. Yes. So they basically do mobile phone towers, and with 5G coming on, everyone needs way more mobile phone towers. And so we look upon that and go, yes, recessions, might slow that down in terms of mobile phone companies expanding, but it's something they're going to be doing over the next 5-10 years anyway. There's scope for them to pick up. We think it's not recession proof, but it's certainly recession resistant relative to, say, a warehousing REIT, which could easily see a lot more variability in its returns.
Great, thanks for that, Damien. We've had one other question from Sharon Coates. This has come up a couple of times, but we haven't touched on it. So she said she recently read an article about an AI program named Aladdin, owned by BlackRock, which influences the stock market. She's just curious about your opinion on that and the effects on the market.
Yeah. So AI strategies. Everyone's trying to run AI strategies and see what they do. Look, it's very difficult. What tends to happen with AI strategies is they over sorry, I've got a complete mental blank on the word I'm looking for. They over specify the model. So what happens is, if I'm trying to find out, if I'm using AI to work out whether something's a car or not, I have this definitive answer. I can show it pictures. I can go, is that a car? And the AI goes, no, it's not. And I say, you're wrong. Yes, it was. And then the AI updates itself and goes, oh, okay, the car looks like this. And then I can keep sort of sending it those things. And there's sort of definitive answers on those. Do I recognize this as a pedestrian? Don't I recognize it? And other factors like that. For stock markets, there's this thing about, okay, what was the answer? Did the stock price go up? Is that your answer as to whether it was right or not? And so it puts in all these factors and goes, did the stock price go up? Now, the stock price might have gone up for none of the factors that was in your model. So you've got 6,000 factors that go into the model, but the stock price went up because the government changed the regulations, or whatever it is that, or it loosened the foreign buyers rules or something like that. Now your model doesn't know that, and these, especially these big data ones, doesn't know that was the reason why it went up. So it tends to go back and go, well, it was, this company, I don't know, starts with a B, and a lot of other companies starting with a B went up on that day, and so therefore I'll assign that a value of saying, that's a positive in my model. And with, depending upon how you're doing your AI, some AI models, it's actually very hard to tell why a company, why the AI model likes the company. And so sometimes you can't even go back and analyze and say, well, why do you like this company? And actually get back to an answer that goes, no, that's nonsense. You need to take that out, because just the way the AI is put together is it's that information is hidden from you as a researcher. And so what tends to happen is, AI models come up with these fantastic strategies for how you could have made lots of money up until yesterday, and then as soon as they get turned to tomorrow, they're too they've been overspecified for a particular period. So the other one I'm often wary of is, there's a lot of ones that have these implicit correlation factors built into it, and correlation is this is a very hard. It's very volatile, and people sort of assume that the correlation is going to stay the same. And so you sort of go, oh, I'm just going to assume that correlation between these stocks is 0.7. And you're like, well, yeah, it's average 0.7, but sometimes it was 1 and sometimes it was minus something. And so, yeah, the average came out at 0.7, but, is that actually what you want? So yeah, so I can't comment, having said that, I can't comment specifically on Aladdin. I haven't looked at in detail at that, but the thing I'd be trying to look for, if I'm ever looking at a quantitative strategy, is working out what's it actually doing. So and what does it come up? So an example of, we use some clustering analysis, which is sort of similar to AI. So we use its dendrograms and things like that. So we use that to try and work out whether stocks are in the wrong sector. So we feed it all this information, and there's all these geek sectors, and we use our own sectors, and we sort of throw it all at it and go, tell me whether all the stocks in there are the same based on AI type measures. And then it throws out and it goes, oh, here's a stock that's different to everyone else. And we can look at it and go, we don't then trust it. We then look at it and say, oh, okay, here's a stock. Is it actually really different to all these? And then you go back through and you look and you go, no, it's the same. It just happened to have particular factors over that period that made it different. It might have been under takeover or something like that, so it looked different. Whereas if you trusted all the AI for, say, sectors, especially over the last 6 or 12 months, you'd have all your resources and all your banks in the same sector and say, yeah, they're the ones I should be comparing with each other. Whereas you're like, no, they're very different companies. I don't need to compare resources with banks. I actually want to sort of separate out differently. So, yeah. So AI, really handy to use, but I certainly would not trust a strategy that only relied on AI for its investments.
Awesome. Thanks for that, Damien. I hope that gives everyone some insights into AI investing. So now we've got our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, which investment strategy is your preferred for the second half of 2022? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And next week, the podcast will be on the Australian Housing Report. So same time next week, 12:30 on Thursday, the 8th of July. So Damien, do you want to...
14th, Sam.
14th. Apologies.
One week, not one day. Yes, but anyway.
So yeah, Damien, do you want to give the viewers just a bit of an overview about what's in that housing report?
Yeah, sure. What we're going to do is just run through the calculator, the housing calculator we have, and adjusted for the we've had a 1% rise in it since we last looked at 1% rise in rates since we last looked at it, and so just want to sort of update that. So the actual report will be coming out tomorrow, and then we'll talk about it next week on the website. So so if you haven't so you can either find that on our website tomorrow if you're around, or register for you can register there for emails as well if you want to get a copy of that report when it's out.
Excellent. Okay, so that almost wraps us up. So thanks again, Damien. That's really insightful stuff. Appreciate your views. Great. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. So if you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and you can book a call with me or one of the team. Don't forget to like our video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more content or episodes from us, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.